Investing in financial markets can often feel like navigating through a maze of options. Two of the most popular investment vehicles that many individuals consider are exchange-traded funds, ETFs, and mutual funds. While both types of funds offer diversification and are commonly used to build investment portfolios, there are distinct differences between them that can impact your investment strategy, costs, and overall financial goals. Understanding these differences is essential for making informed decisions about where and how to invest. This video explores the top 10 key differences between ETFs and mutual funds, shedding light on their structure, costs, management, and suitability for different types of investors. 1. Structure and trading mechanism. One of the most fundamental differences between ETFs and mutual funds is their structure and how they are traded. ETFs are designed to be traded on an exchange, much like individual stocks. This means that ETFs can be bought and sold throughout the trading day at market prices, which may fluctuate during the day based on supply and demand. Mutual funds, on the other hand, are not traded on an exchange. They can only be bought or sold at the end of the trading day at a price determined by the net asset value, NAV, of the fund, which is calculated after the market closes. 2. Cost structure. When it comes to costs, ETFs and mutual funds have notable differences. ETFs generally have lower expense ratios, which is the annual fee charged by the fund to cover its operating expenses. This is one reason why ETFs are often considered more cost-effective for long-term investors. Mutual funds, however, tend to have higher expense ratios, particularly actively managed funds, as they require more resources for research and management. Additionally, some mutual funds may charge sales loads, a commission or fee paid to brokers when purchasing the fund, which can further increase costs. 3. Management style. Active versus passive. Another major difference lies in the management style of the fund. ETFs are typically passively managed, meaning they track a specific index or a basket of assets, such as the S&P 500, with minimal intervention by fund managers. This approach aims to replicate the performance of the index, not beat it, making ETFs more cost-efficient. On the other hand, mutual funds can be either actively or passively managed. Actively managed mutual funds have a portfolio manager who makes decisions about which assets to buy and sell in an effort to outperform the market, which often results in higher management fees. 4. Minimum investment requirements. Mutual funds often come with minimum investment requirements, which can vary depending on the fund. These minimums can range from a few hundred to several $1,000s. This requirement may be a barrier for small investors who wish to invest with limited capital. ETFs, however, do not have minimum investment amounts beyond the price of one share. This makes them more accessible for investors who want to start with smaller amounts of capital and allows for more flexible investment amounts. 5. Tax efficiency. Tax efficiency is another area where ETFs have an advantage over mutual funds. Because of the in-kind creation and redemption process used by ETFs, they are generally more tax efficient. This means that investors in ETFs are less likely to be subject to capital gains taxes as frequently as mutual fund investors. In mutual funds, capital gains taxes are typically triggered when the fund manager buys or sells securities within the fund, and the tax liabilities are passed on to the investors. Thus, ETF investors are usually able to avoid some of the tax burdens that come with mutual fund investing. 6. Liquidity and flexibility. Liquidity refers to how quickly an asset can be bought or sold without affecting its price. ETFs offer high liquidity since they are traded on exchanges and can be bought or sold at any time during market hours. The price of an ETF fluctuates throughout the day, giving investors flexibility to execute trades when it's most convenient. Mutual funds, however, can only be bought or sold at the close of the trading day, and their prices are fixed at the NAV at that time. This makes mutual funds less flexible for investors who wish to make real-time decisions based on market conditions. 7. Dividends and income distribution. Both ETFs and mutual funds can generate income through dividends, but the way income is distributed can differ. ETFs typically pay out dividends quarterly or annually, and investors can choose to have the dividends reinvested or receive them as cash. Mutual funds also distribute dividends, but they may do so more frequently, such as monthly or quarterly. In mutual funds, investors may also have the option to reinvest dividends automatically, which can compound returns over time. However, mutual funds may not offer the same level of flexibility in dividend reinvestment options as ETFs. 8. Transparency. Transparency is an important factor for investors who want to understand where their money is invested. ETFs generally offer greater transparency since they are required to disclose their holdings daily. This means that investors can see exactly what securities are in the fund and how much they are worth on any given day. Mutual funds, on the other hand, typically disclose their holdings only quarterly, and in some cases, annual reports may not reflect the most up-to-date information. This delay in reporting can be a disadvantage for investors who want to closely monitor their investments. 9. Investment strategy and customization. ETFs tend to follow a more passive investment strategy, tracking an index or sector, which means investors have less control over the individual assets within the fund. While this can be ideal for those who prefer a hands-off approach, it might not be suitable for investors who want to actively select specific sectors or industries. Mutual funds, particularly actively managed ones, offer more customization since the portfolio manager makes decisions based on market research and analysis. This can be attractive to investors who believe in the potential of certain industries or want to tailor their investments based on specific goals, such as growth or income generation. 10. Risk and diversification. Both ETFs and mutual funds provide a degree of diversification, but the level of risk can vary based on the fund's strategy and underlying assets. ETFs tend to be more diversified if they track large market indices, as they include a broad array of stocks or bonds. However, the passive nature of ETFs means they can be more vulnerable to market downturns, as they follow the performance of the index, including its worst-performing assets. Mutual funds, particularly actively managed ones, can offer more targeted diversification, as fund managers have the ability to make adjustments based on their view of the market. However, actively managed mutual funds carry the additional risk that the fund manager's decisions may not outperform the market, leading to potential underperformance. In conclusion, both ETFs and mutual funds offer unique advantages depending on your investment goals, risk tolerance, and financial situation. ETFs are generally more cost-effective, tax-efficient, and flexible, making them a great choice for investors seeking low fees, liquidity, and transparency. Mutual funds, on the other hand, can provide more personalized investment strategies and are ideal for those who prefer actively managed portfolios or are looking for a more hands-off approach to investing. By understanding the differences between these two investment vehicles, you can make a more informed decision about which one is right for you and your long-term financial objectives.